All right. February 6th, Accounting 202. We are going to move on into chapter 10. So I am assuming you all have your course packs. So let's go to page 47. And I'm going to follow along with chapter 10, but we'll also have the course pack open. Everybody here? Sign in the chat to tell me you're here. Everybody back? You know how much I love talking to no cameras on. And I want to ask you guys for a favor, if we could take a little class picture, because I like that sort of thing. So I wonder if you guys could turn your cameras on just for a second. I don't want to force you, but I'd love to take a class picture because this is kind of a wild situation. Thank you, Han. You look great. Now, one year, one of my students said, "Oh, Hanson, you look great. Nice to see your face." Hannah, good to see you. Let's see. Hey, Aisha, lovely to see you. Josie, yay, welcome. Alan, yay. Joffrey, yay. Exocell, I see your forehead. It looks great. Rio, thank you. Oh man, you guys look wonderful. There's people there. Yay. Okay, who else? Who else? Who else? My camera won't let me turn on. I think it's a Wi-Fi issue. All right. Once one of my students said, "Judith, I haven't done my hair yet. I can't turn my camera on." I don't notice. Zoom pictures are really small. Ava, good to see you. Let's see anybody else on the other side. Let's see. Dana, wonderful. Bryson, wonderful. Elias, good to see you. Arena, good to see you. And that's all right. If you don't have a camera or your hair's not in perfect state, you guys always look like movie stars to me. But anyway, all right. I'm going to take a quick picture because I think it's cool that you're here. There you go. There's my class. I'm so excited. There you are. Let's see. Is there anybody else? I have Ava, Adam, Elias. I got you. I don't know why it thinks there's people. Who am I not here? Exocell, Arena. Ah, okay. I don't think I have Arena in this first picture. All right, I'll do a second picture. What the heck? This will be good for roll too. So, but I want to do roll based on your chat participation. All right, you may turn. Oh, there's more pictures here. I'm gonna take another one. I really promise we'll get some work done. All right. Look how good you guys look. Aren't you sick of the snow days? I am. All right. Okay. Back we go. All right. All right. So let's turn to page 47 and we're going to do, oh, off go the cameras. We'll turn to page 47 and in your course pack. And we will go there now. So we had done on a week ago, golly, a week ago, we had done notes payable. And that really worked well because we had studied notes receivable in chapter 8. So that was kind of good. So notes payable is like the mirror image of that. And so we had done, we're going to focus on current liabilities today. So we've covered notes payable. When you issue a note payable, the company cash goes up, debit cash, credit notes payable. No interest because no time has passed. Okay. Then we talked about accruing interest, debit interest expense, credit interest payable. And you should have all this in your course pack, but it's also on my slides. Okay. So then we said, how about when we pay off the note? When we pay off the note, cash goes down, note payable gets debited. If there's any additional interest expense to record, we debit that. And if we had interest payable, we debit that to clear that out. And then we credit cash for the principal of the note and all the interest that the company owes. So we did a little bit of that stuff there. So now we're going to go over to sales tax payable. We finished with that on Thursday, but I want to talk you through that. So we said they show sales of 10,000, sales tax of $1,010. What's the journal entry for sales tax payable? Okay, so and you guys built that entry for me. I didn't do it. I just said, you guys do it. And we'll do. All right. And you can see both of those. So we said, and please, if you run a small business, please pay your taxes. They are ruthless when they think you have avoided taxes. So I think I changed the facts slightly on this one to match. The course pack matches what you actually pay in Washington State, what Macrina would actually pay in Washington State. So here we go. They collect the money, debit cash, they credit sales for the sales amount, and then they credit sales tax payable for the balance. In this case, it would have been cash 11,010, credit sales 10,000, credit sales tax payable 1,010. And then we said, this is the formula for calculating sales tax. X is sales. In this case, it was 6%. Over here, it's 8%. But you have to, if you only have the total proceeds, so I'm going to write that in the chat. If you only have the total proceeds, and when I say proceeds, I mean the money they collected for a sale. How do you calculate tax? So you build a formula and you say, here's my total proceeds. X is sales, 0.06x, or whatever your tax rate is. In this example, we used 0.08, is equal to the total proceeds. And then you solve for the sales, and then you calculate the sales tax. So I can't remember. Did you guys do this exercise in class last week? I don't think we did. So I'm going to give you a minute to work on the sales and sales tax if your total proceeds is $10,476. And if you think you have the answer, put it in the chat for me, but direct message me. And if you have questions, ask me. So I'm going to give you a minute to do that. We're not building a journal entry. I just want the dollars. Let's see if you are correct, Vanessa. I brought a calculator, but as usual, I put it somewhere safe. Now, let's see. Vanessa, you are correct. Dana, you are correct. Dawood, you are correct for the sales number. Casey, you are correct for both. Nick, correct for both. Alaric, no. Read the formula here and see if you can calculate that. Dawood, correct? Jaffrey, nope. You did the same as Alaric. So read this formula. This is the total proceeds, 10,476, and it's sales times 8% of X, and you want to solve for X. Skylar, yes. Hannah, no. Same. Use this formula, but change the number for the sales tax and the total proceeds. Manishka, correct? Andrew, correct? Yay! You guys are getting this. So, all right. Han, you are correct for sales. Anybody else? Okay. So here's the answer for sales. Yeah, Josie. Tax is not a rate. I want the dollars. Josie, yes, you got it. Elias, nope. Sales revenue is not 10,476. This is the total of sales and sales tax. Let's see, Aisha. Aisha, you are correct. Hans, sales tax, yes. Shira, no. Okay, so here is exocell sales is correct. Bilal, no. Manishka, fixed formula. Well, the total will change depending on what you collected, and the sales tax rate will change. And it's exocell, no. All right, here's the solution. I'm putting it in the chat because I don't have a stylus with me. So we take the total. So read what's in your course pack. The cash register total is 10,476. The sales tax rate is 8%. So looking at the chat, I don't know if you can see that there. This is the formula. No, it doesn't come over. All right. 10,476. So let's see if we can do, there it is right there, even better. Look at the PowerPoint. So this is the formula. So we're saying, pay attention to the sales tax rate. And we're saying, hey, sales tax is going to be 8%. So sales is 100%. Sales times 8% is sales tax, and it adds up to 10,476. So you combine these terms. So you have a variable X that has no coefficient in front of it. So you assume 1. It's always 1 times X right there. Okay. So 1X plus 0.08X equals 1.08X. Okay. It's equals. Right. And then you take 1.476 divided by 1.08 equals X, and you solve for it, it's 9,700 in sales. And then you take that sales number times 8% and you get 776. All right. Now, if you had not done that, if you had not done this, what if you said 10,476? I'll just multiply that by 8%. Okay. Well, sure, but you would pay more. So if you took 10,476 times 8%, you'd actually end up paying more taxes than you owe, and we don't want to do that. I don't want to do that. I want to pay my fair share, but not anything more. So I'd come up with paying, and some of you got that number, 838. You multiplied 8% times the total amount. You don't have to do that. You multiply it by the lower amount. Never pay more than you have to, unless you're giving to charity, and that's a whole different thing. All right. Any questions on sales tax? Okay, so we turn the page in your course pack, and we've got unearned revenue. No, I want to do payroll next. I want to skip unearned revenue. You guys know how to do unearned revenue. We already did that in Accounting 201. So let me, I'm going to jump ahead there. I have slides on unearned revenue. I got a lot on payroll. I want to cover the payroll. Here, unearned revenue, the original entry, the company debits cash, credits unearned revenue. That's step one, and I'm looking on page 48. Page 48 in your course pack. I'll just do this real quick. And then we'll go back to payroll. Okay. So when do we use unearned revenue? We use it when the customer prepays. So when you buy a ticket to a concert or a play or a movie in advance, that's unearned revenue. Typically, you buy the movie ticket the same day, so that's a bad example. But airline tickets, you buy them ahead of time, magazine subscriptions, insurance, prepaying for hotels, etc. So looking in your book on page 48, assume the Mariners sell 100 baseball tickets, season tickets. So, and they play quite a few home games. 1782 for the tickets. When they collect that money, look at how much money that is. Whoops. That would be your first entry on page 48. 100 tickets, 1782. They collected all this cash. But unearned revenue is a liability. Why? Because they owe you the game. At the end of the first month, the Mariners have played 13 home games. It can record those 13 out of 81 games earned, and we just prorate that. We say 178,200 divided by 81 games is $2,200 per game. That Mariners have earned 28,600 just for those seats. Remember, those were just a specific set of seats, outfield reserve, okay? They sell a lot more than that, but I didn't want to have huge numbers, okay? So those are the entries on page 48. All right, so we're going to backtrack. No, I'm going to backtrack on the slides, but you guys are going to turn to page 49. All right. What was using a graphic, put in the chat, please, your reaction when you got your first paycheck. I want to know. Monica is shocked. Manishka's happy. Tears of joy. Happy, happy. Dana's a little surprised, excited. I went shopping immediately. Oh no. Happy. Okay. I was shocked. I was stunned. I was somewhat grumpy. Okay. Because I knew what I was earning and I knew how many hours I had worked. And I said to myself, this paycheck is a lot lower. Yes, Arena, I can relate to that. So why? Because we have something called, and I'm looking at page 49. So let's go to that. Because you might get paid $100, okay? But surprise, you have to pay federal income tax. You have to pay FICA, which is a federal something something, and it stands for Social Security and Medicare. And that's 7.65% out of your paycheck. Federal income tax depends on how much you make. Washington State does not have a state income tax. If you're covered with medical insurance, you might have to do like a premium. Companies often pay the big part, but we often have to pay the little part. If you have union dues, you have to pay that. And then for me, I have to have withholdings for my retirement. So 10% of my paycheck goes into my retirement account. And that's my money, by the way. All right. So Social Security and Medicare, 7.65 up to a cap. So I want to explain that briefly to you guys. Social Security, can you see my, yeah, you can, and Medicare cap. Okay. So in 2024, you had to pay Social Security tax 6.2%. Medicare is 1.45. Together they make 7.65. So you are taxed 6.2% on your earnings up to 168,600. After that, it stops. There's a lot of reasons behind that, but I want to tell you that one way to make sure that there is Social Security when you are older is to get rid of that cap. And that way, everyone can be fairly taxed at 6.2%. All right. Sorry to get political, but there was when this law was created, only millionaires made 168,600. And that is considered a low wage now in places like Bellevue where the cost of living is so high. Okay. So just a little fun fact there. There is a cap. Rich people don't have to pay. Even some middle class people don't have to pay after they've earned 168,000. The first 168,000 is taxed at 6.2%. All right. So it's really quite surprising how much is taken out. So for example, in my example, this is not one person. This is a whole bunch of employees. For this pay period, all these employees' gross total wage was 140,000, but down here is their take-home pay. So quite a bit of taxes and withholdings taken out. All right. So that was my shock with my first paycheck. I ran over to my dad and I said, "Look at this. Can you believe it?" And he said, "Yes, welcome to taxes. And be sure to vote in the next election." All right. So companies pay us. W College pays me and some of you. Wherever you work, you'll get paid, I hope. So salaries are a fixed amount, wages are hourly. And I know a lot of people that would prefer to be paid hourly. So you're paid for every hour you work. So you have to do three things for companies to make the payroll journal entry. They have to calculate and know the gross earnings, all the payroll deductions, and net pay, what we call take-home pay. Okay. So any questions so far? Oh, I do have a question. Is retirement contribution the same as savings? Not exactly. The money that is put into retirement is tax-free while you put it in and taxable when you take it out, depending on whether it is a normal retirement account or not. There are other retirement accounts that you can tax up front. Okay, so we're looking at page 49, middle of the page. Assume a company wants to record its payroll for the week of March 7th. The corporation owes its employees $100,000. This is an example. Okay. The corporation owes 100,000. The corporation will pay its employees 67,000. Okay. So the company must pay the difference. The company must pay the difference to various authorities, the Internal Revenue Service, Social Security, etc. And trust me, you do not want to not pay those. All right, so here's the example problem, and then we're going to do the one in your book. So in this is the facts. The facts at the top of your page 49 are different. So you can do a practice problem, and it's showing Social Security and Medicare total of 7.65, federal withholding state. This is not Washington State because there's taxes. And let's say these employees don't get medical, union, or retirement. So their take-home pay. Okay. So this would be the journal entry number one. Don't write this down in your course pack. You can write it down in your notes. the company records the expense, salary and wage expense. Now, up till now, we've just booked debit salary expense, salary and wage expense, credit cash, or credit salary payable. It's more complicated than that. We have to record all the rest of these taxes. So salary and wages payable is a lot smaller because it's the take-home pay. The rest are payables to tax entities. Okay. FICA is Social Security and Medicare, federal income tax, state income tax, and you get that data right from here. Okay. When we pay the bill, it's really when the employees cash their checks, debit salary wages payable, credit cash, and then down the road they will turn over that tax money to the government. They'll debit all those payable accounts and credit cash. Okay. All right. Okay, so what I want you to do, sorry, one more step. One more step is for companies, they have to record the additional benefits. So looking down at page 49, the first journal entry is the employee paychecks. Second journal entry is when the employees cash their paychecks. The company debits salary, wages payable, credits cash. Third journal entry is the accrual of the additional taxes the company owes on its employees. Okay. And you can see that at the top of the page, additional employee paid portion. Additional. So what is this stuff? So companies have to match the Social Security and Medicare. They have to match it. So the employees pay, in my example on the PowerPoint, the employees paid $7,650. Company has to match it. If you are self-employed, you pay both. The company also has to pay unemployment benefits, federal and state. Okay, and that's there, and that'll be given to you. Okay. All right. So let's go back here. I've demonstrated your 3 journal entries, and let's go and let's do the one in the course pack. Okay. And I've got them all there. So you have 2 minutes to load in the numbers from the course pack for journal entry number 1, 2, and 3. And I've got all the titles here just in case you need them, but you may not need them. Okay. So you're going to use this data up here and this data up at the top for journal entry number 1. Journal entry number 2 is clearing the payable. And journal entry number 3 is that additional employer paid portion. Okay. So I'll back up here and show you that journal entry so you get an idea of it. Okay. So take a minute and do that journal entry. You have, oh, I don't know, 2 minutes. I'm going to set my watch, my phone. And if you guys have questions, put them in the chat. I'm going to see if I can. Any questions on that? I'm going to see if I can share my answers. I took a picture of it. I think I can. Hmm. This is when I wish I had a stylus. Okay, I don't know if you guys can see this. We shall see. I think you can. Let's see. Here are the solutions. Now let's talk through these and let me know if you guys have any questions. So this is the total amount owed. Salary and wage expense. 78,080 is our take-home pay. That's salary and wages payable. And then you're just loading these based on their description. FICA, 10,700. Federal income tax, 28,000. State income tax, 35. Medical premium payable. Union dues payable. Retirement payable. Looks like retirement is 5% of the gross amount. And then finally, the balance, the take home, okay? Then this is the portion that is cleared when the employees cash their checks. And then this remainder part, payroll tax and benefits. Some homework problems combine these, okay, just so you know, as one account. Others do not. So the difference between a tax and a benefit is tax, medical insurance, retirement matching. They don't have to do that, but companies often provide that. But these taxes are required. They have to match the Social Security and Medicare, and they have to pay the unemployment federal and state. And then medical insurance payable is the additional portion for medical, and retirement match is whatever they're matching here. So they're not matching dollar for dollar. So if the employee puts in $7,000, they're matching like 30%, 40% of that, 40% of that. Okay. Questions on that? Guys good? Okay. So I am going to put that picture down and move on in the course pack. So we have a practice problem. We'll do that another time. And now I want to make sure my timing is good. It is 12. Okay, we're good. So turn in your course packs to page 51. All right. My plan is to give you the last 10 minutes of class in your breakout rooms. Okay. So Appendix G, Part 1, homework is due Tuesday night. And like I said, time value of money is my favorite topic. It's more into the realm of finance, and I love it. Okay. So I'm going to shut this down for now. Sure, save it. Oh, I shouldn't have saved it. Oh, I guess it didn't take too long. So time value of money. Oh, so good. Such a good subject. I just got to find my PowerPoints on it. Here we go. So in the chat, I want you to answer some of these questions. Question number 1, would you rather receive $500 now or in 10 years? Why? Why or why not? And if you don't want to put it in the chat, that's fine. You can just call it out. Now. Now, Manishka, the money's value will go down. We're going to follow up on that with you, Manishka, because of inflation. All right. So, Manishka, if you don't mind sharing, or Alan, you said now because of inflation, or Manishka, you said the money's value will go down. So,
Yeah,
can you
I
explain?
mean, I've like heard about it a lot that like over time the value of $1 decreases. And even if you think about it, like $500, I don't know, 100 years ago was worth a lot more than it is right now. And like one of my classmates said, I think a large reason is because of inflation.
Alan, do you want to add to that? Maybe with an example?
I think it's the same. It's just the amount of money that the value of the money is just gonna continuously go down over the years because of inflation.
So when you both use the word value of the money. So can you put that into language that my grandmother could understand? What do you mean the value of the money? It's still 500. I know what you mean, but say it to my grandma.
Could I give an example?
Sure.
So, like, let's imagine, let's say, for example, a pencil costs $1 in 2025. Let's assume that inflation goes up every year by 3%, right? So that same pencil in 2026, you'll need $1.03 to buy. So how much power did I lose with that dollar? I lost 3 cents.
Perfect. I love it. So you want to buy the same thing, but it takes more money in the future because of inflation. Perfect. So if you go talk to your grandmother or grandfather, ask them how much things cost when they were in your age. They will tell you, oh, eggs were 20 cents or $1 or something. And that'll make you feel bad. But remember, they had less money than we have now, too. So, so here's question number two. Your grandmother gave you $1,000. Let's share my screen. Not sharing. Share, share, share. Your grandmother gave you 1,000 and put it in the bank at 10% interest for 10 years. In the chat, she told you that it was your money, but she also told you you can't touch it for 10 years. How much would be in the bank in 10 years? Make any assumption you want with how interest is calculated and put it in the chat. You have 90 seconds, so you don't have a lot of time. 10 years. Nicely done. So, what was your assumption, Casey?
I just did 1,000 times 1.1 10 times.
You just did it over and over and over again,
Yep.
10 times? That
Hmm.
works. So 10%, 10 years. So correct me if I'm wrong. And Manishka, yes, compound interest. You did 10%, 10 years. See if we can do this. Yeah, you can see that clear. Time. I'm going to go 1.10. So now I have 1,100, and then he did times 1.1. And he kept doing that till he got up to 2,593. Okay, excellent. What if you use simple interest? How much would you have? So you guys used compound interest. Simple equals 2,000. How'd you get that? We did 10% a year is 100. 100 times 10 is 1,000. Okay. Which would you rather have, compound interest or simple interest? This is a trick question, but go ahead and answer it. Which would you rather have? Compound, which is better?
Compound.
Because why?
Because you accumulate more money than simple over time.
So if it's your money, you'd rather have compound interest. But if you are borrowing money and you have to pay it back in 10 years, you'd probably like the lower one.
Oh
Okay.
yeah.
Yeah. So, all right. So we're going to come back to these. All right. So go to page 53. It's kind of hideous. Can you see it? Yeah, you can see it. Okay. I want you to write in something here at the top in caps. Single. Okay. Single amount. There is a simpler way, Andrew. Of course, you guys can use your calculators and use the compound functions there, but this is a single amount, this table. So we're going to, for this class, I want to teach you the tables. All right, so the first table we're going to call table 1, okay? Second table is going to be table 2. Third table is going to be table 3. Fourth table is going to be table 4, all right? So we don't need to do what I demonstrated, which is to take 1.1 and keep putting it in our calculator, all right? So we're going to say the PER is the number of periods, 10. The interest rate is 10%. So we go to the intersection here and we come up with something, a number that we're going to call a factor. Okay. I'm using table 1 because my question is asking what is the future value of one amount, $1,000 in 10 years at 10% interest a year. Okay. And the answer to that is, let's put in text. We're going to take the 1,000. We're going to multiply it by that table factor, 2.59374, and we're going to get 2,593.74. So, oh, sorry, how about one? You guys all see that? So if I ask you and I say, hey, you got $2,500, what's it worth in 5 years at 6%? You just go to table 1 because it's single amount. It's a single amount. Table 1. So we know we're asking what's the future value of it. Okay, so we're going to stop there. I want to give you some team time, but that's going to be what we talk about on Tuesday with Appendix G, Part 1. So Appendix G, Part 1, there's other factors. We're going to be looking at future value, present value, and so forth. But that'll be on Tuesday. And then when we get to part 2, that'll be when we start talking about bonds. All right. So I'm going to open up the breakout rooms and have you guys work on a little bit talking about these this data set and the assignment that you have here. And maybe I'll drop it in the chat so you guys can do that. Let's do that. I'll drop it in the chat so you can access it. I don't know if I can put attachments in the chat, come to think of it. Is it going to let me? Nope, it's not going to let me. Let me see if I can drag it. Yes, I can. Okay, everybody download that before you go into your breakout rooms. And I'm going to open the breakout rooms. All right. And I'm going to try and drop that into the breakout room as well.